Hello, everyone. Thank you for joining the second quarter 2022 market update by Tobias Financial Advisors. We really appreciate you taking your time out of your days, busy days, especially in the summertime, to join us for this. I hope we're going to have a lot of great information for you today. And I know with vacations and family time, it's really important to us, and we thank you so much for joining today. But we'll get into it right now. Before we get fully started, there may be some disclosures. So here's our first disclosure. Just want to let you guys know this is a general information webinar. There's going to be no specific investment advice here. This is just general information. If you have any specific questions, please reach out to your investment advisor. And again, as a reminder, past performance does not indicate future returns. That's very important when considering your goals. This is just an economic update and some specific investment classes that we'll cover. A little bit of background on Tobias Financial Advisors. We were founded in 1980. We have $600 million in assets under management. A long history of the firm with some assets. We have a great team of people here, 75 years of experience, and we have a lot of designations that were some of them very difficult to earn. Chartered financial analysts, certified financial planners, CPAs, among those designations. So really a talented bunch here, here to help you meet your goals. A little bit about me. My name is Chad Neesmith. I'm the portfolio analyst at Tobias Financial Advisors. I've been here about a year and a half. I came from Atlanta, moved down to sunny South Florida. I love it here. I do not see myself moving back at all. Florida is fantastic. I do trading, investment research. I do some of these investment webinars for you. I answer some client questions, and I'm part of the investment committee here to do research and to get our models correct and invest money to meet your needs and to fit your financial plan. We have a guest today. It's Maria Dmitriev. She is a senior portfolio specialist from Vanguard, where she's liaison for between the portfolio managers at Vanguard and financial advisors like ourselves. So if we have any very specific questions with regards to how Vanguard views the economy, how Vanguard views their investments, we reach out to people like Maria who will help us out and help us understand. We've got some really great topics that she's going to cover today, and hopefully we'll have some good back and forth and be some great information for you. Maria, thank you for joining. How are you doing?
Thank you for having me, Chad. I'm doing great. I am in Philadelphia, though, so maybe not as good as you in Florida, but still good. It's warm here.
It's hot everywhere. I mean, it is. I'm from Atlanta, and I hear about all my friends' 100-degree heat all over the country. So I'm sure Philadelphia is definitely feeling the heat wave too. Luckily, in South Florida, we have the ocean breeze. If you're close enough to the ocean, if you're lucky enough to get it. But yeah, thank you so much for joining. I really appreciate it. So before we get into today's agenda, I do want to focus on a really important topic, and that's just focus on what you can control. Predicting the market is an impossible game, and it's really important to just focus on your plan and your individual goals and let the market kind of handle itself in some sense, but also have a very broadly diversified portfolio, manage expenses, turnover, tax exposure, and make sure that it's a good risk profile for what you have and to meet your goals. So yeah, the first things first, before you predict what's going to happen, if we have a recession or if markets go up, markets go down, focus on your plan and your long-term needs. That's the first and most important thing. So today's agenda, we have first off the second quarter update that I'll provide. We're going to go back in time, where we're going to study a little bit about historical market performance, where we go way back about 100 years or so. And then I'm going to go into the second quarter, which is a very small snippet in time. We'll talk about how returns are for the market. And then we're going to go into asset class returns across a lot of broad asset classes year to date. So we'll zoom out a little bit, 6 months instead of 3 months. And then Maria and I will get into a discussion where we're going to talk about labor market, inflation, and fixed income, and how it should be included in portfolios, if it should be included in portfolios. We'll get into the details as her slides come up. So before we get into everything, let's take a big step back. Long-term, the stock market. This is from 1926 to the current day. As you can see, it looks like, if you zoom out, a pretty nice return over time. $1,000 invested in 1926 has turned into $11.3 million today. And that is through all kinds of trouble that we've had. It started in 1926, so we started with the Roaring '20s. We had the Great Depression, then into World War II, We had a good economy in the 50s, some in the 60s. Then we went into stagflation in the 70s. We had Cold War that we fought through, the Cuban Missile Crisis, then in the dot-com, Great Recession, coronavirus, all of it. When you add it all combined, $1,000 turns into $11.3 million, which I think is a very compelling story for you. Yeah, I mean, that's what you need to focus on, is that over the long term, the market tends to go up, and it's a good thing to invest your money for your retirement. But if you look at the bull markets on the top left and the bear markets on the bottom right, if you're looking at the bear markets, you can see the average length in months and the months it took to recover, the total gains. It seems to be all over the board. You know, we've had some short bear markets that have been down a lot. You know, the Great Depression was 34 months, down 83%, which is wild. It took 151 months to recover. And then we've had some shorter ones that have been 2 months, you know, 1930 or August 32 to February 33. It was down over 6 months, but then over 2 months, it just magically recovered. So, you know, as far as predicting bear markets and how far they're going to go down, how quickly they come up, it's very difficult to do that. And then you go over to bull markets. Again, we see the same story. Some of them really short, some of them lasting a long time. The one from 1946 to 1961 lasted 15 years. 15 years of bull market. You know, you can imagine being 7 years into a bull market and think, wow, we're really due for a recession. We're really due for a pullback. That's not necessarily true. I mean, it was another 8 years before we got a bear market there. So I think this is a very nice slide to really put in perspective the long-term and long-term investment success that we've had, and how resilient the U.S. economy is, and how resilient the stocks can be over the long period of time. Now we're going to get into the second quarter. The second quarter, we're seeing a little bit of red. The next slide, we may see a little more red, as a lot of things are down. The year has really been defined as an interest rate increase rolling into recessionary scares. The U.S. stock market's down almost 17% for the second quarter of 2022. International and emerging markets are also down, but a little bit less than the United States stock market. Global real estate's down 17%. And the bond market, this is the single worst start to the year for bonds. Just for the quarter, bonds are down almost 5%. But you know, we'll talk a little bit more about bonds in the coming slides and what we can do about those in our portfolio. I'd like to mention that the dollar is just on a tear this year, and that's put a little bit of a damper on the emerging markets and on the international stocks. But for the most part, you know, a lot of things are down, and we're going to talk about different asset classes here. The one shining star this year is oil prices. Commodities have done really well. You see at the top of your screen, Brazil is slightly positive at 2%, 2.87%. That's because they're a commodities exporter, so they've done well in this environment. Gold's edging out a slight victory. And then as we move down, it's a sea of red pretty much. There's kind of nowhere to hide this quarter. You know, we're looking down here at government treasuries down almost 10%. You know, we think of treasuries is a very safe investment, and they are in a credit risk sense. You know, we're not really afraid of the United States government going bankrupt. They have the highest credit rating in the world, but they're still down 10%, and that's the interest rate sensitivity that those investments have. So there are inherent risks that are in different investments, and we definitely saw that as interest rates moved up this year. China down 11. It was also down pretty heavily last year. Then we get into some of the value stuff. The Russell 1000 value was down about 13. That's large cap value stocks. It was holding up pretty well in the first quarter, and it's slumped down a little bit now, catching up with the other stuff that's down. Emerging markets bonds in US dollar terms down 17%. So if you think, man, bonds are a pretty safe investment, there can be some risky stuff where emerging market bonds down 17% in 6 months. It's possible. And as we go down further, we'll see the government credit long-term bonds. So these are government bonds down almost 22% year to date. These are, this is again, interest rate sensitivity that we've seen year to date. It's just when you put together a portfolio, you have to take all risks in consideration. And interest rate sensitivity is one of those that we're gonna have to talk about with bonds. And then at the very bottom, we see NASDAQ, which is growth. The third from the bottom down, almost 30% for the quarter, mid cap, and the Russell 2000 is small cap growth stocks down 30%. So the growth side really got hit hard this year. They have a different relationship with interest rates than some value stocks would have, and that's why we're seeing such a big pullback on the growth side. But all in all, you know, the good news is things have come down, but earnings haven't come down that much. So on a price to earnings basis, a lot of these stocks are cheaper than they were to start the year. And just remember that your long-term plan is really resilient, and we can really ride through this wave right now. This is things may be down, but again, it's a long-term investment that we showed earlier in the presentation that we really need to focus on. I do want to mention that in this slide used to be Russia. So I want to highlight the importance of a diversified portfolio. Russia used to be here, but earlier in the year, those investments kind of blew up. So if you were 100% in Russia, you wouldn't even be on the map here to even see a negative 30% return. It was down 100 and down so much that they removed it from the list. It wasn't even worth talking about. So it really highlights that you want to be in a very diversified basket of asset classes, and to avoid massive mistakes that can happen in portfolios. So that's, in a nutshell, my introduction to how things have been in the second quarter and the year. We're going to talk a little bit about labor markets. We're going to talk about inflation. I'm going to bring Maria in a little bit. So the Federal Reserve has a dual mandate of price stability and full employment. How does Vanguard see the labor market starting in the pandemic? How is it morphed over time? And then what do they see as far as jobs going forward, Maria?
Yeah, sure, Chad. And I guess maybe to take a step back, the reason why we're even talking about the Fed and the central bank here, and looking at their dual mandate of price stability and full employment, well, the main reason is what they're doing with rates. And kind of going back to your slide, the negative returns, all was driven by rates, what the Fed policy is, how the Fed is changing their policies. So essentially, they're driving this volatility. They are the source of volatility over the past 6-9 months or so. So that's why it's important to look at the labor market. It's important to look at inflation, because that is what the Fed is paying attention to. So that gives us a good idea of where we are headed, and kind of we can explain the returns that we've seen so far. So maybe to start with the labor market, and that's just the part of their dual mandate. The labor market is still strong. If you look at the left-hand side, we can see that prior to the onset of the pandemic, up to 2019, the unemployment rate was below 4%, and that's where we are right now at about 3.5, 3.6%. So we are back to the pre-pandemic levels, very strong recovery, and in terms of unemployment numbers, depending on what we see month over month, by the end of the year, we should stay here at mid threes or maybe even go lower by the end of 2022. And the reason for such a low unemployment number, the main reason for that is the drop in the labor force participation. So when we look on the right-hand side, we can see that the breakdown of people that left the labor force during pandemic, post-pandemic. So essentially anything after 2019. And what's interesting, we had net retirement, so essentially people that were expected to retire during 2020, 2021. So those were about 800,000 people. But a big portion of that drop in the labor force participation was unexpected retirements. So people that didn't expect to retire for the next 5-10 years, they did in 2020 for various reasons, maybe the fear of of COVID, or for family reasons. And that, coupled with people that had to leave the labor force for family reasons. So you have young families with small children, daycares are closed, they had to leave the labor force to take care, one of the spouses had to do that. So essentially, those two sectors combined made up about 1.5 million people, which is a lot in terms of the drop in participation. And the issue at this point is that Vanguard doesn't really expect about 80% of those people going back to the labor force. So we are looking at permanently lower participation rate. Why? So why is it important? Why do we even care about the participation rate? Well, because if we switch to the next slide, we can see what it really does to the labor market in terms of labor demand. So on the left-hand side, we are looking at job openings per every unemployed person. And at this point, it's almost 2 per 1. So anybody that wants a job, they can get a job in current market. And what it means, on the right-hand side, we're looking at much higher wages. So as a result of that red-hot market, wages are going up. So on the real basis, we are still behind inflation prints that we are seeing month over month, but and higher wages are good, something that the Fed wants to see, that most economists want to see, but we never want to get in a wage price spiral, because then it's going to be really hard for the Fed to taper down inflation to really get it under control. So a little bit of wage pressure is good, but only, to a degree.
Yeah, those are great points, Maria. Yeah, with the people leaving the labor market and not coming back, is it a situation where we may see lower unemployment, but still less jobs in the future, or jobs growing at a slower rate to get to the same unemployment rate since participation is down?
Yeah, so at this point, when you look at the unemployment rate, essentially we are at full employment. So the Fed is looking at that as, the job is done there on that front. So now that's why they're kind of shifting their focus to inflation. So 3.5, 4, that's full employment. And that question comes up a lot in the conversation about recession, because it's really hard to have, stagflation, high inflation, kind of recession where unemployment is so low. So that's the reason kind of we are staying away from using the term stagflation, where we are still in a really strong labor market. What we are seeing too in terms of getting people back into the labor force, and you remember that the big portion was unexpected retirements. Employers have to be much more flexible with their arrangements. People don't want to work full time back in the office, so it has to be part-time, more flexible in terms of the place that they're working from, and kind of they have to be more creative essentially to attract people back. So that would drive the number even lower.
That's really interesting. With the talk about recession coming, how if we were to get into recession, how does the labor market look? I know it's really resilient right now, but should we roll over? What does Vanguard see as some scenarios with a possibility of recession in the labor market?
Yeah, so as far as the probability of a recession over the next 12 months, it's still pretty low. Vanguard sees it at about 25%. And then it's a little higher. Well, it is higher over the next 2 years. So the next 24 months, it's north of 60%. So, when we used to talk about soft landing from the Fed and kind of them being able to navigate this and not really crash the economy, the probability of that is low. So now the question is it going to be a shallow, short recession? And that's kind of what we are leaning towards. Again, pointing back to strong labor market and inflation being the core issue that the Fed is trying to tackle right now.
That's great. Great information. We talked a little bit about the labor market here. I know that labor market moves into inflation. They're related in a way. So, we move to the next slide. How does Vanguard see inflation going forward? I know it's a big issue right now, all over the headlines. Talk about how you're seeing inflation.
Yeah. So, it feels like every month market participants are getting surprised by inflation prints, because the expectation was originally that inflation would peak by mid-year and then would slowly taper down. Vanguard just released our mid-year outlook, and we are expecting inflation to be higher towards the end of the year. So above 7% on the headline, and the headline CPI includes your volatile food and energy prices. So essentially it's going to take longer to get inflation under control. And it's, again, going back to the Fed, our chief economist keeps telling us that, the Fed is a little behind the curve. They should have moved earlier, but they didn't, because they didn't really think that inflation was going to spread to all the sectors. They expected it to be more transitory. And I'm sure, every article we read earlier in the year was saying transitory, and we don't even want to use that word anymore. But the reason why they said that, and many economists agreed with them, was because in the early days of the recovery, when they looked at the sectors that were driving that inflation number, those were focused on 3 main sectors. So that's transportation, automobiles, and lodging away from home. So typically, those sectors make up a very small portion of your overall inflation number. And that's when we look on the chart on the right-hand side, we can see in the first bar, the 5-year average for those 3 sectors is 0.1%. So essentially, you have a 2% print, only 0.1% is made up of those 3 sectors. In 2021, though, you can see that light green, that's the 3 sectors that I mentioned, it made up half of your overall inflation number. So that's the main reason why, the Fed expected people, like all the restrictions are lifted, people will travel more, people will buy a few cars, and then it'll go back to normal. But unfortunately, what happened, what we observed early in the year and all through through June, was that inflationary pressures spread through non-COVID sectors. So essentially, the contribution from those three went down, but then everything else went wider. So that's the main reason why the Fed has to be more aggressive in their rate hiking cycle. And that's why we saw negative returns from the bonds that we did year to date, because of all the repricing on the rate side.
Yeah, I do want to talk about bonds. I know that we're still seeing some pandemic core inflation. I know I'm seeing it through ticket prices for traveling. I did recently go to Europe, and the flights can be expensive. I've been flying a little bit. I know that flights have been canceled. There's labor shortages in airlines, so it's something we're kind of working through in our economy. And I know that everyone here watching is experiencing some sort of inflation. I mean, you cannot hide from it right now. But over time, we're expecting it to go down over time. The Fed's very aggressive in their hikes, and it should be under control. Are we seeing it? I know it's going to be higher towards the end of the year. What kind of time frame does Vanguard see inflation cooling off? Is it a few months? Is it a whole year, 2 years?
Yeah, so at this point, and again, it's given all the information that we have available right now, we think that inflation is going to peak towards the end of the year, and then it'll slowly start going down.
That's great. All right, thank you for that on the job market inflation. Yeah, we definitely want to talk about bonds. I showed you guys how bonds have done this year. It's been down a lot. It's been rough. How should investors think about bonds in their portfolio, Maria? How should they incorporate them?
Yeah, fixed income is definitely the area that we cover the most these days, simply because of performance, like that slide that you showed, negative double-digit performance. And when we talk about bonds, a lot of times investors are questioning the validity of having bonds in the portfolio. But the good way of looking at it is kind of looking at investors' time horizon and trying to see where the bond return is coming from. Because all these negative returns that we saw, they all came from negative price return. Essentially, that's just the bond math. Rates are going up, bond prices go down. So as for long-term investors, this is a good thing, because rates went up, and even though we had to stomach these negative price returns, over the long run, the investors are going to benefit from higher coupons. So if you're looking at a shorter duration portfolio, you already had time to recover most of those losses, and now you're just benefiting from reinvesting in higher coupons. The issue only comes when investors are not really matching their investment horizon to the duration of the portfolio. So let's say they need their money in the next 2-3 years, and then the duration of the portfolio is 10 or 15. That's not giving them enough time to recover. But other than that, we always wanted to see higher rates. The zero rate environment was not really sustainable. So as long as we get to the other side, investors should benefit, the long-term investors.
Yeah, that's a great point. I do want to add that how we view time horizon and duration is a little bit different. Our durations across the board are a little bit shorter, so we're a little bit more like the top right of your screen right now. This is a 1.8-year duration bond where interest rates may go up but not affect the price as drastically as the bottom right screen, the 18.5-year time horizon. But the good news is, if you're a long-term investor, you can reach out and lock in those long-term rates for a longer period of time if you'd like. But that's something we can talk about with your financial advisor and just sort out your goals and what you want to do with your portfolio. Bond prices have gone down a lot. We've gotten some clients really worried about fixed income. It may go down some more. What might you say to an investor that is really worried about their fixed income that's gone down a good amount, and they're considering selling it and going to cash? What do you say to those kind of investors?
Well, as far as getting out of fixed income at this point, it might not be the best idea given the slide that you showed in terms of price returns. So right now, those are paper losses, but as soon as the investor sells out of those bonds, those are already losses on the books. So what we usually, when we talk about changing the strategies, maybe moving in terms of duration, longer or shorter, it's kind of, we think that it's a little too late now. So if you wanted to shorten your duration, the best time was maybe coming into this year, but not right now. Now it's better to just benefit from higher coupons and just continue to reinvest.
Yeah, I totally agree with you. The pain has been mostly realized in fixed income. I mean, it's the worst start to the year for fixed income of all time. So interest rates just rose at an insane rate and a lot. So, and that rolls into the past. We've heard about fixed income and the 60-40 portfolio, meaning 60% stocks and 40% bonds is generally a balanced portfolio. Been hearing a lot about how it's dead. And is there a benefit from owning bonds in portfolios, and do they still have a place in your investment assets?
Yeah, that's the question we get a lot, given the performance, and typically you would expect bonds to be a better buffer against your equity drawdowns, and usually that's the case. When we look on the left-hand side, we can see that stock-bond correlation is usually negative, except some short periods of time how we had in mid-1990s where the correlation was positive. But overall, if you have a longer time frame, it's a negative correlation, so you do benefit from that diversification from your bonds acting as a buffer. And if you look on the right-hand side, the only thing that would change that correlation, that relationships, that would be higher inflation. So at this point, we still believe that the Fed would be able to get inflation under control. So the long-term inflation number, the 10-year trailing number, is going to be 2% under base case scenario. And that is the bottom brown line, where in that scenario, your correlations are negative 0.27%. So that's a pretty strong negative correlation that gives you that diversification effect. The only time when correlations change to positive is when inflation is north of 3.5%. And again, this is a long-term inflation number, the 10-year trailing number. So we were below 2% up until last year. And in order for us to get above 3.5%, we would need to be printing north of 5 for the next 5 years, year over year. And this is not a high probability scenario. So that's why, it's not our baseline. And that's the reason why we think that 60-40 is alive and doing well. It's just, we have to zoom out and not really focus on a quarterly or 2-quarter performance.
Yeah, that's a great point. And yeah, I just want to back up a little bit. Correlation is how the relationship of how bonds and stocks move together. So when we say positive correlation, that means generally when stocks go up, bonds would go up, and negative correlation, meaning when stocks go up, bonds may go down, or vice versa. So that's why when it's negative, that means they're moving in opposite directions more so than not. And that's what provides you with diversification in your portfolio. That's something we really want to pay strong attention to, because diversification is the only free lunch in investing. And negative correlations are good for us because it reduces the overall, when you put it all together as a big pie, it'll reduce how much your portfolio moves generally whenever assets in that are uncorrelated or they move in opposite directions. But what Marie was saying, if I'm getting this correctly, is that if the Federal Reserve, it's unlikely that we're going to see very persistent long-term inflation in the economy. And the blue line at the right screen is pretty unlikely to happen. The baseline, we're more likely to get negative correlation in the future. And so that means that bonds are still good for your portfolio. And I definitely agree with that. I think the bonds fixed income is going to be great for looking for as part of a diversified portfolio. That's something that we've heard a lot of, is 60-40, are bonds even good anymore? We definitely still think that. Is there a situation where we, I know it's unlikely, but is there a situation where we do see inflation for a long time and then correlations rise, or is maybe that's a small chance of happening? What's Vanguard's thought on that?
At this point, it's a low probability scenario, just given the willingness of the Fed to do whatever it takes, and everything that comes from the Fed, from Fed Chair Powell. He's willing to have a recession essentially in order to get inflation under control. So kind of don't fight the Fed, and we agree that they should be able to achieve their target inflation numbers over time.
Yeah, that's great. Yeah, the Federal Reserve is hiking rates at an extraordinary pace. It's not in my lifetime for sure, it hasn't happened, but maybe a little. I'm 30. I don't know. In my 30s, maybe not super historical. I didn't see the 80s. I didn't see those periods. I wasn't around for those, but I've studied them some. It's great information in bonds. Thank you, Maria. I really appreciate it. I'm going to move on to some closing, and then we'll closing thoughts, and then maybe we'll get some questions at the end. Okay. Appreciate you being on. Yeah. So as we move out of fixed income, we're going to talk about future outlook and how Tobias sees things. There's some good things that are going on in the economy, some optimism. I know there's not a whole lot of optimism right now in the markets and on the news when you turn on the news, but the labor market is strong. We just added over 300,000 jobs in June. The labor market is just insanely strong. It's never been this strong since I can remember, and I don't think it's ever been this strong. So secondly, oil prices have broken below 100. They were last week. They're actually back just above 100. So they're around $100 right now. You may see prices at the pump dropping below $5 for a time period. So that's going to ease some prices. That's going to ease consumer spending, where they can take money they would be spending on gas and spend it on some other things, maybe food or some other areas where prices have gone up. So that can help the consumer and help keep retail sales at a high level. We are seeing earnings come through. This is the first week of a full earnings season. Earnings have been strong. We haven't seen any really negative earnings reports. So what I'm gathering from earnings season right now is that companies are kind of bracing for a slowdown in the economy, but earnings themselves are speaking for themselves. They're speaking for themselves, and nothing really negative is coming out of. We may see one or two poor earnings reports, but for the most part, they're really strong. And we're also seeing a lot of companies like Pepsi able to pass along prices to consumers without any issue. So for now, inflation, companies are able to handle inflation, and it's a good hedge for your portfolio. So I'll move on to some points of caution. Inflation's really high right now, as everyone knows, and higher than we're getting in a lot of fixed income yields. So with negative real yields, which is inflation minus what we're getting in fixed income, we're getting a negative yield when you put it in real terms. So that's something of caution. Portfolios are having a hard time keeping up with inflation. But as Maria said, we're looking at it peaking this year, and then maybe Vanguard's maybe thinking it's going to start trickling down towards the end of next year. So that's great news. The Federal Reserve is in a really tricky spot. They're tightening monetary policy at a really rapid pace. And if they don't get it right, it could backfire on the economy and put us into a more severe recession than we are predicting. If we are, going to have a recession again, Maria said 65% chance over the next 2 years. And that's the most up-to-date thing that I'm hearing from some other firms as well. But they're also seeing a mild recession. So, and even if we're in a recession, asset classes can go up. It's sometimes the market acts in alternative ways in the economy. So you never know. It's really hard to predict where the market's going to go. Another point of caution is the yield curve is inverted historically, meaning this means that short-term fixed income, so bonds that may come mature in a year or so, 2 years out, are at a higher rate. So you're getting paid a higher percentage on those bonds than the ones that are further out. And that's a historical sign that recession may be looming. But yeah, those are just some ending points for you paying attention to or watching us today. We're going to get some questions. We do have some questions that have been submitted before the webinar. So I want to go into inflation. Inflation is on everyone's minds. Maria, what can investors do in their portfolios to combat inflation?
Yeah, that's something that we discuss a lot. And as you pointed out, equities are a good inflation hedge for investors in their accumulation phase. So if you have about 50% in equities, that's a good hedge. For later in your investment journey, TIPS, Treasury inflation protected securities, and commodities can be a good option. TIPS are good because they are protecting the portfolio from unexpected inflation. So you invest 20% of your portfolio in TIPS, and 20% of your portfolio is protected. So you're maintaining that purchasing power. The reason why many investors are looking to commodities is because commodities have a higher beta to unexpected inflation. So essentially what it means is you only need to invest 5% in commodities to protect 35% of your portfolio. So you're essentially getting a bigger bang for your buck. But those would be the main options depending on where you are in your investment journey and how much protection you need for your portfolio.
Yeah, it's great points, Maria. And again, yeah, those are asset classes we're considering at Tobias. And just consult your financial advisor should you have any questions on the specific investments to add to your portfolio to combat inflation. We're here for you anytime. So, we talked earlier about recession. I know that you gave probabilities of recession earlier. In a scenario where we may not have a recession, what kind of things would need to go right in order to in order to avoid recession?
Yeah, I mean, it's a little bit tougher now. The soft landing, it's harder to engineer. So that's the reason why now the probability for the recession is higher over the next 2 years. But our economists believe that it's still possible to avoid recession, but a few factors would have to go right. So you mentioned one of them, oil prices. We would need to see oil prices consistently below $100 in order for people to be able to use that money towards their food budget to kind of balance that out. We would also need to see the Fed even more aggressive before the end of the summer. So we already hiked 1.5% up until June. We would need to see another 1.5% by the end of the summer. Another factor is inventories. We would need higher inventories in order to put that downward pressure on inflation. So, and a big one, you pointed to that too, is the labor market. We would need to see about 1 million people get back into the labor force to alleviate that pressure, the wage pressure that we are seeing right now. So as our chief economist likes to say, it's not a multiple choice, it's all four that need to go right in order for us to avoid the recession in the next 2 years.
Mm-hmm. Yeah, thank you for that color. And again, we'll keep monitoring the economy, and things can change. Things change from one quarter to the next, and we just keep updated on the economy, and hopefully we'll manage your portfolios correctly. So with that said, thank you so much, everyone, for attending today. We really, really, really appreciate your time. Maria, thank you again for attending and giving such valuable insights to our clients and attendees in this webinar. Again, please reach out to your financial advisor at Tobias. Reach out to us if you have any questions on the webinar. We're happy to answer any questions you may have. And we hope you have a blessed day. And we'll see you next quarter for the next webinar.
Thank you, Chad. It was a pleasure.
Great. Thank you so much, everyone. Have a great day.
Have a good one.